So who ends the day talking about insurance? I was asked that. And here's the thing. I started out as an insurance lawyer. Let me tell you something, talking about insurance in London after a day of hearing about how crypto has, pardon my language, crapped the bed, I actually think is really important. Insurance, you guys can all come up. I'm going to filibuster while you're coming up. Insurance is what made modern industrial capitalism possible. Without Lloyd's, I mean, for good or for bad, without Lloyd's, we wouldn't have had it. After 9/11, New York real estate almost shut down because there was no insurance, there was no cover for terrorism risk. We had to pass a federal law to cover that. Same thing with nuclear power risk. We would not have nuclear power plants in the United States and in other countries if we didn't have insurance. So it's fundamental, and we've heard all about the risks and problems associated with crypto today. I would suggest to you, and this is a fantastic panel, you might think insurance is boring, but the idea of laying off risk and transferring it, it's in addition to being fundamental to business, it's really cool. It's kind of a form of, I mean, and you can start the clock, by the way. It's a form of legalized gambling, if you will. It's possible to insure almost everything. So we actually have here on this panel, we have somebody who has the first Lloyd's cover holder that covers crypto native risk. What's that? Well, he claims the only Lloyd's cover holder dedicated to crypto risk. We have broker, we've got security folks, we have people who really understand this. So what I'd like to do, I know some of the other panels we didn't do introductions, but I'd like to give each of you 30 or 40 seconds to talk about who you are and what your connection is to crypto and to insurance. And I'll just start to my right. Tell the folks your name and what you do and the connection.
Great. So my name is Ben Davis, originally from Canada, but live in London for the last 8 years. I head up the digital asset team at Superscript. We're a Lloyd's of London broker, and we exclusively focus in my team on insuring companies in the digital asset Web3 metaverse space. We are the only broker so far to accept crypto as premium and also work natively with... Wait.
You accept crypto as premium?
Yeah.
How does that work? Are you allowed to do that?
Yep, we're allowed to do that, yeah.
Is it, and that's for, it's for property, casualty?
Everything, yeah. So we can accept it in crypto and then we transfer the fiat.
Oh, I see. So you don't actually hold it. I've heard of insurance companies that are actually, it's in the life insurance context, that are actually accepting crypto as premium and holding it. I think, Jared, maybe you can speak to that.
I mean, I guess.
Yeah, in the Bahamas, right?
I don't remember. It might have been a Bermuda, Bahamas.
Bahamas. Anyway, so I cut you off. You actually accept crypto as premium.
Yeah, absolutely. Yeah. So we'll the whole policy is still denominated in fiat, but we'll be able to accept it in crypto and then take the FX risk and remit it to the appropriate syndicate to carriers. And so we deal with all types of insurance, from the theft of digital assets to working with the boards and directors to insure their liabilities.
Awesome. Well, thank you so much for joining us today. My law partner, Dan Healy. Talk about yourself, Dan, and your connection to insurance and crypto.
Sure. So I'm a partner at Rudnick. I've been litigating insurance coverage for 20 plus years. And over the past 10 years or so, I've focused a lot more on cyber insurance coverage. I have a treatise on it. If you need bedtime reading. But the natural progression of insurance and technology is leading to what we're talking about today with the insurance of crypto assets. It's certainly a need, and we'll hear from people who have started making a difference by filling that need. And for policyholders out there, we always say you have to buy the policies or else we can't help you. And so we're not enemies of insurance. We just come and help you when your insurance company doesn't pay when it should. So that's what
Unless they're Evertas. Yes. And what's interesting too, I mean, it's interesting to hear that you can go to a broker and get coverage because I have clients in the crypto space. I have one client, a fairly well-known, they're kind of a DEX, but they're a foundation, very compliant. They went to 75 markets and got declined by everyone but Realm, I think, which isn't a rated carrier, which is kind of problematic because most contracts that you have require that your insurance be with a rated carrier. So it's heartening to hear that we have some development in the space. And with that, Jared, talk about yourself and Evertas and what you do.
I'm an engineer by training, started Evertas because I was working in institutional custody at Bank of New York Mellon, the world's largest custodian bank, and realized that you can't have institutional custody without having insurance. So I am not an insurance person at all. I'm an engineer. And
You're an engineer, right?
yeah, exactly. I think I said something like that.
Yeah.
It's the last panel of the day, guys. You know, we're going to power through this. But we were the first crypto insurance company in the world. We started in 2017. We were the first company to get regulatory approval to launch a digital asset insurance carrier, the first company to become a Lloyd's cover holder, and we offer a abundance of products from custody insurance, you know, theft or loss of digital assets to your fidelity and fiat coverage that you need. We're working on a limited D&O product that's focused on the space, property insurance for miners, tech E&O for blockchain infrastructure, people staking assets, smart contract insurance. Our paper right now is exclusively through Lloyd's, so it's all rated, and it's been a really exciting, interesting journey. And you know, we work with Superscript, and we would take payments in crypto, except the brokers don't, which is actually something we should talk about because we could.
Look at that. You come to a Brown Rudnick conference and you do business on the stage.
Right.
I like that.
And we have an amazing policy forum that Brown Rudnick's been a part of, which is why I'm here.
Yeah. Proud to have Evertas as a client. Apparently, because they're a client, Dan, we're not allowed to sue them. There's no waiver that allows for that. So, I mean, that's how cool I think this is. I've spent my career suing insurance companies. It's the first insurance company I've represented in 20 years. But it's totally transformative. And I would tell you, I mean, my core belief is that we will not have a thriving crypto ecosystem. You won't have banks being able to hold custody and allow for transfer and transactions unless you have proper insurance for it. Just like Venetian merchants needed it and English shippers needed it in the 17th and 18th century. So with that, if you could introduce yourself, Katharine, and talk about what you do at Coincover.
Yeah, sure. Oh, that is really too high up, isn't it? We're a tech provider. Why is that feeling bad? Sorry, I'll just hold it. Is that better? I don't want to give anyone a migraine. It's way too late for migraines. Wine is coming soon. We're a tech provider. So we do two things. We do key material backup, and we also have a theft prevention product. And in common with my two colleagues to my left, we also have Lloyd's of London insurance. So we currently serve about 300 firms across hedge funds, asset managers, exchanges. We support a South American government that's accepted Bitcoin fairly recently. We work with quite a lot of big infrastructure providers, so Fireblocks, Copper, and we're just about to go live with a bit of hardware that's quite famous in crypto, which we're very excited about. So we spend a lot of our time lobbying sort of regulators and policymakers. We're really trying to fix the two major problems, which is, on the one hand, people losing access to their crypto, and on the other hand, all the hacks and scams and theft. So lots of our customers, particularly exchanges, are looking to de-risk, so we can provide them with something insurance-backed to say, look, we know if our technology for any reason lets you down, we've got Lloyd's of London coverage. So particularly in that sort of draining the swamp, which I think from all the speeches I've heard today, we're very keen to help really get that digital assets industry to fulfill its potential.
So when you talk about the risks that you're talking about, those are, talk about that a little bit.
Yeah, sure. So what we tend to see, particularly with the exchanges, is that they're essentially self-insuring. So they know for every 1,000 transactions, there'll be a handful, let's use that very generic term, a handful that go south. And what they're essentially saying is, to stop us getting absolutely slated on Twitter and LinkedIn and to keep the regulator sweet, we'll just put a few of those customers right. And that's super risky. Listen to the bankruptcy chat, which was very interesting. So it means that we can give them something which is a tech product with insurance. And look, I think until relatively recently, there was no insurance, right? So our business was around at the birthplace of the crypto industry, and all of our customers were saying, we're really worried about either losing access, all the hacks and the scams. Please give us that peace of mind. And I think we often find, I've been talking to regulators for about 5 years now, and 5 years ago, I won't tell you which jurisdiction, but I had to explain to a regulator what Ethereum was. They kept telling me that they wondered what this Ethereum thing was. theory.
With an I, right?
Yeah, exactly, yeah, not made by Apple. So look, I think it's been very much a learning curve, and I think where you've had a mass exodus from people that are in TradFi getting into the DeFi space, they're like, well, actually, there's a lot here which translates.
So I'm really interested. So one of the interesting things about insurance is that there's a thing. Does anybody know what a loss pick is? It's a little bit of insurance jargon. A loss pick is basically, I don't know, the sort of maximum percentage that you will end up paying out. In order to be profitable, you have to come in at lower than the percentage that you've predicted. So if your loss pick is 25% and you end up with 40% losses, you've lost money. If it comes in at 18%, you win. I'm oversimplifying vastly. But a thing that I've discovered, and Dan has too over the years, is insurance companies don't like paying claims. So one of the things that they do, there are two ways that they avoid paying claims. They underwrite very carefully. And if you're underwriting a fire insurance policy, it's easy because you have 175 years of we actually in the United States, we have fire maps. You probably have something similar in the UK. The actuarial information is actually, it's available. Same thing with workers' comp. You have loss ratios. Same thing with life insurance policies. People die. So how do you figure out, we talked about this last night. I'm not asking you to talk about anything proprietary, of course, but I was fascinated by your description of how there's an underwriting process. And it sounds to me in a way, I've heard, and Jared will talk about this, one of the difficulties for underwriters, I've been on panels with them, they're like, how do we underwrite this stuff? Isn't part of the answer that the information is already there in the blockchain? It's kind of like title insurance.
Yeah, sure. So the more wine got drunk yesterday at that event, the more vocal people got about this. So it's very interesting to me that the insurance providers on the stage, our business is about the same age, sort of 5-6 years old, something like that. So the birthplace of crypto was that we had this great thing, the distributed ledger technology. Look, it's immutable, anyone can see it. But there wasn't really enough data. So the analogy that we often draw is imagine the poor guy who took the call, hi, we've just invented the motor car, can you insure me? Well, no, not really, because you drive it up the high street, we don't know how fast it goes, we don't know who you're going to hit, we don't know who's going to die, we don't know how many people have got massive brain injuries. Imagine being the poor dude that has to write the first car insurance policy. So for us as a business right now, we protect millions of wallets. We've analysed billions of transactions. We're probably best placed to price that risk in a way that no one else can. So whilst that data has been there, I just think it took a while. Data is meaningless without context, right? So I'm sure those of you that are insuring will feel the same. It just took a while to have that data presented in the correct way. And I think we're now so far ahead of anybody else in terms of being able to price that. We know that just cost-wise, if you send $1,000 worth of Bitcoin to anywhere, your exchange will charge you, 1%, something like that. We're going to charge them a fraction of that to give them some insurance protection against that. So we're very much hoping that in the near future, it won't be a nice to have. It will be something that you can't afford not to have. And of course, over time, the prices massively drop.
Price it in. Title insurance probably sounds like the most boring thing in the world to most people, and I did title insurance work for a few years. It's pretty boring. What's cool about it, though, is the risk is retrospective. It's all in the title record. The other cool part about it is, to your point about the business model, every single residential real estate transaction in the United States, I don't know if it's true in the UK, has title insurance. It's just baked in, and it's part of the cost of getting a mortgage. So, that's interesting. I hadn't actually thought of that before, but in part, that's what you're doing, right? You're looking back at wallets and figuring out if they look dodgy.
Yeah, exactly. And I think one of the things that's interesting is we see a huge amount of repeat transactions. So we actually do take our customers can pay in crypto, and a very small amount choose to do so actually. But we see a huge amount of repeat transactions. So our customers have got 30 days to highlight what they believe may be, a scam or theft or whatever. So what we tend to find is that if we've got one client that once a month sends their, overseas relative, $100 worth of crypto, it's likely that if that transaction's done once a month for the last 2 years, unless your, cousin then decides they are a South Korean hacker, which is unusual, but generally there's so much repeat business in our book that, we're in a good spot now. I'm conscious that you haven't introduced yourself. Poor
yeah, no, I was going to say...
Yeah, he's famous.
Yeah, so...
famous in crypto.
Ian...
Infamous.
In addition to having an incredibly cool jacket, and I don't know what that is, very, very cool. Tell us about yourself.
Did you say I have 5 minutes of my intro?
What's that?
5 minutes of my intro.
You have 7 minutes in your intro.
Hi everyone, my name's Ian Taylor. I'm board advisor at CryptoUK. We're UK's trade association representing 150 members of the community across the board, all different market participants. We focus a lot on developing policy that's proportionate and balanced in the UK, and also working with all the different government agencies to ensure that the policy is then transposed into regulation that's fit and proper for the activities that are performed. I also lead KPMG's crypto and digital asset consulting practice here in the UK, so pretty plugged into lots of products and services and those folks building really interesting new innovative tech in the community. And to answer the question about relative to DeFi and insurance, I talk to a lot of DeFi projects. I've been a DeFi user for many years, and in terms of insurance is, I see it almost like regulation. These are cornerstones for any industry to mature and become perhaps legitimized, for one word, and also for adoption. And we have seen the curve of adoption over the last few years, both in retail and institutional, really increased significantly. So yeah, happy to be on a panel to talk about the final topic of the day.
Thank you. So one of the interesting, I'm gonna pick on a broker for a second. I'm sorry, you didn't know that I was gonna ask you. It's not meant to be a rude question, but I guess one of the questions I have is, if you study the history of brokers, brokers served something like a trust function initially. If you go back to Lloyd's, the original Lloyd's, a broker would essentially find underwriters for a ship. They would vouch for the fiscal probity of the underwriters and would also vouch for the decency of the ship, right? Do you think that setting aside sort of the immediate market opportunity, do you see the underlying technology in crypto displacing the need for brokers at some point?
I think I think broadly no, but I think on an on-chain environment probably. So I think there's always going to be that client that wants to have somebody that holds their hand and takes them through that process and can advise them on what to do. But I mean, we're already seeing it with the likes of Nexus Mutual, where they've got a very robust ecosystem of people buying and selling cover with no intermediary, essentially.
But they're not insurance, are they?
No, they're not insurance. No, they're not insurance. I would say they're the closest thing to, but they're not insurance. I would think that what we do as a broker is represent our client to the insurance companies to find the best fit, and then present those quotes to our clients. That function still has value in the crypto industry because there's a lot of complexity.
Yes, I agree. I was just accused, my wife got me a thing on my wrist that grades my sleep and tells me what time it is and tells me I should walk more. And it also get messages. So somebody in the audience accused me of heckling you. So I'm sorry if it seemed like I was heckling.
No.
Because I actually think the answer is you probably need it even more because of the complexity of the market.
And I was saying from a legal perspective, when you think about that, when your analogy to Lloyd's a long time ago, and sort of the answer about how things are now, have two very divergent legal obligations, where one, you're talking about your duties to your client, representing your client to the insurance companies, and in the example about Lloyd's that Stephen used, you're actually talking about the broker's duties to the market, which is the opposite. And when you translate that into something goes wrong and you have a claim, the way that plays out can be very different. And so how this market evolves will have long-term implications for the policyholders.
So I agree. Go ahead, Jared.
So if someone has to pay insurance brokers a percentage of the money that comes into me, right? Like my inclination is, gosh, brokers, what's the point, right? The truth is that there are a lot of brokers who are value add. I know brokers who will go to 65, 70 markets over 6 months to get you a $1 million policy that they're barely making any money on, right? They're all doing it on spec. They're not putting anything out there. Superscript, great partner of ours, very technically focused. They really understand the industry. The problem is there are a lot of brokers who are actually bad brokers.
Who are actually what?
They're bad brokers,
bad
right?
Brokers.
And so what people need to understand is that brokers are getting paid a percentage of commission, right? Similar to financial advisors in the US who are getting a percentage of what is going on. So they may steer business to someone because they're getting paid more, not because it's necessarily right for you. And there's an effort, particularly in this space, and in this space in particular, the brokers are kind of doing what they've done for 400 years, is they're trying to differentiate themselves. But instead of differentiating themselves by having expertise and knowledge, a lot of them are just differentiating themselves by slapping a different label on top of the same insurance that everyone else has.
Well, I want to talk about that, actually, and I'd also encourage folks to ask questions, too. I guess one of the fundamental questions, if you know the insurance that I know and the insurance Dan knows, they're mostly forms. They're created by, in the UK, NMA, Lloyd's, in the United States by ISO, now Verisk. If you tell me what a CG000, you tell me you've got a CG000 1-1204, I know what policy that is. That is a...
Palley, you need to get out more.
Well, I probably do. No, it's a standard general liability policy issued by ISO, issued in December of 2004. I know what the exclusions are, amendments are. So the question is this, and it's true, like in cyber, which, Dan, you've sort of grown up in your practice around that, cyber started out without forms. And gradually, insurance companies have manuscripted, meaning created their own policy forms. Where are we, Jared? And then I want to ask you, Dan, where are we in sort of, are there forms? Is what we have good enough, or it's a two-part question, if you can keep them in order. If they're not good enough, why not? And two, is there something about crypto that just needs, is there something that we need to rethink in order to write the coverage?
So before I give the real answer, I just want to tell you, everyone, that he set me up so well for a nice little heckle. I don't know where the forms are because I'm waiting on mine. Sorry.
I was a softball.
Yeah, I mean, you set them up, you knock them down. He's my Bud Abbott. Maybe I'm his Lou Costello. Anyway, so I think it's interesting to look at the evolution of crypto insurance. So this started off and everyone said, there's computers, this is a cyber product. And particularly if you look at cyber insurance, so the first policies were written like 2013, 2014. Right. If you think about what cyber insurance, particularly a decade ago, was, it was like, we're going to pay for your PR firm, we're going to pay for someone to come in and like fix your network, and we'll pay for identity monitoring. And it was a relatively small market compared to like a crime or the specie or the vaulting market, right?
And specie, for those who don't know it, that's what, Jared?
So that's vault, stuff that's in vaults. So this would be like your fine art, your rare wines that are in a vault. Anything that goes in a vault is the specie market.
Pretty low risk, right?
Yeah, generally. I mean, this is, we talk about actuarial tables, right? You have, literally centuries, maybe even millennia of data on like putting things in a vault, right. And then fire codes and how to protect stuff. So what happened was very quickly everyone's like, this doesn't make sense in the cyber markets, and so things moved over and said, well, could it go to crime? And they're like, it's not really crime. Because again, 2013, 2014, how were you storing crypto? You're putting them on a hardware wallet or a laptop that you've stripped down and secured, and you're throwing it in the vault, right? Cold storage. So they're like, hey, this is a thing. It's in the vault. It has money, and if it stays in the vault, it's safe. And if someone breaks into the vault, it's not supposed to have it. It's not safe. This is good. We understand this. And so it went into this market. The problem is that, and actually the bulk of insurance, like from a dollar perspective for theft or loss of crypto assets, is coming out of the specie market, right? I believe actually your policy, I think, is a specie policy, I'm guessing. And correct me if I'm wrong on that, right? The biggest dollar amounts are specie?
Yeah.
So when someone says, I got $100 million of insurance, that's a specie policy. The problem is that specie underwriters deal with things that go into vaults.
Cold storage would be an equivalent. Yeah. So basically what you're saying is it's not terribly risky and it doesn't take that much imagination and there shouldn't be losses.
It's also very easy to underwrite because you're ensuring the thing in the vault doesn't get destroyed, basically, right? If someone breaks, and someone's not going to break into the vault and steal it. And people know how to say, like, okay, the TL rating is this, it's good, it's a good vault, right? What's happened is this space has evolved. And so now you have, people use the terms warm and hot storage. They're not really rigorously defined. We actually defined it because it has legal implications for our insurance policy. You can find that on our website. And so, when you talk about, multi-party computation, official cryptography, right, or a smart contract in DeFi, you are no longer in the realm of a vaulting policy. And so when you look at these insurance policies, it's not clear that most of these policies actually have any coverage because they'll say things like, a device can never be connected to the internet, ever. Well, okay, but it's an HSM that's connected to the internet. So when there's a claim, it's not going to be your insurance broker who said, don't worry about it. It's not going to be the insurance underwriter who's like, don't worry about it. It's going to be some lawyer in the claims department who's going to look and say, It was on the internet, right? Claim denied. And so you're going to be sitting there fighting with your insurance company who literally has teams of lawyers who work for them and then have on retainer larger teams of lawyers that work for them that spend all day denying claims while you're trying to get your money back and recover your business. And so I fundamentally believe that this is its own class of risk, and that's the way we've approached our policies. I mean, you guys feel free to disagree.
Yeah.
Let's ask Darren, what would you call this new form?
Yeah.
Crypto risk.
So I think we see the world a little bit differently. So the analogy we use for what you're talking about is like saying, oh, I've got 10 Lamborghinis and they're insured as long as I don't take them out in the garage. Who wants to buy a sports car that you can't go and, throw around the racetrack, right? So we take a different view. Our insurance element to our business is based on, well, we can insure your crypto at rest or at move, because you're absolutely right. It's at risk when you send it to the wrong place, or someone hacks you and makes you send it to the wrong place, or someone gets in and sends it to another address. So you're absolutely right to your point to say, well, it's safe if it's over there. Yeah, but the exchanges are moving stuff constantly. So we're a little bit different. We're saying if we allow a transaction, which turns out to be wrong, we'll put it right. But you're absolutely right. It's cyber insurance, it's fine if it's locked, is actually no use to pretty much every crypto business I know. I mean, maybe you can talk to that from your insurance working group that I'm privileged to hear a little bit about.
Yeah, well, I was just thinking going back to this point. It seems that these definitions, taxonomies, and creating new areas of definitions for this, nascent and novel new sector is challenging from everywhere you look. I was just on a call with a guy the other day who builds out standards for derivatives and financial markets, and they're talking about coming up with new ISINs for crypto trading assets. That's happening, and then you can talk about the work of CryptoUK with the insurance working group is trying to help the industry come up with these sets of standards. And I'll go back to the live consultation from HMT in the UK. They talk about insurance in there for retail, part of the financial services compensation scheme. And that really does, again, legitimise an industry and helps bring another billion users in. But the definitions aren't there yet. I hear folks talk about all the time, the taxonomy of which crypto asset does what isn't right yet.
Well, and there's some basic questions too, like what is, Dan, maybe you can speak to this. What is Bitcoin? Is it property? Is it tangible property? Is it intangible property? Is it personal property? Is it an asset? Like, how do you determine what it is? And say we're looking at an old form.
Yeah, and you just heard from our last panel, and who owns it, and who's in control of it, and whose possession, custody, or control does it fall into, is a hot topic that's being litigated. Is this a truly decentralized, platform, for lack of a better word? And those are concepts that insurance was not designed around. Insurance is designed around things like property rights, ownership, custody, who has responsibility and control, because they're going to have the liability, so your insurance covers that liability, which is well defined under the law. And here we have so much innovation, and you're hearing innovation on the insurance side as well, not just on the business side, which leads to probably a drop in predictability, which is another thing that insurance doesn't historically like. It wants it to be predictable, which is why we have these actuarial tables. So it's very interesting to think then, okay, well, what words can we use that are going to be clear and everybody will know what they mean after something went wrong that no one expected to go wrong, or that we thought had a low probability of coming to fruition. And when you don't have forms, then you have people have to be really smart and come up with the right kinds of wording to fit a lot of different situations, which might mean that it could be property that's held by somebody, but is it property? Is it a security? Is it money? And in historic policies, those are all problematic terms because, in your cyber policy, it's not going to cover money. It just won't. In almost every policy I've ever seen in cyber won't cover money itself, but it does cover data. And so then, okay, well, how is data being defined and what does it include? And if it excludes money and someone's saying, well, my cryptocurrency is money, then what do you do, right? And so that's why we have people trying to work on new products to fill that gap, because we have some very blurry areas. And on the business side, they are being litigated by courts, which, one upside of litigation, a lot of businesses don't like litigation, is that you then get an answer from the court that at least everybody knows that's the answer. Unless
For that court in that jurisdiction.
Right,
Yeah,
unless another court changes its mind and goes the other way. But that's why insurance companies tend to use very similar language from one to the other. But it took the cyber world, more than a decade to get there, and they're still not uniform. And lawyers love to argue about what the difference is between resulting from and arising out of. And you can have a whole case over that, right? And we didn't even start talking about crypto terms yet. So, those are some of the concepts that the industry is going to have to wrestle with, and insurance will have to wrestle with as well. And when we have some really big losses, people will be willing to fight about what those mean.
Well, if you take the way crypto is often held too, the question I want to ask is, I actually wrote a blog post about this a couple years ago. Can you insure a DAO? And let me make it even more specific. Let's say you have a DAO that the 5 members of which are members of a multi-sig that controls $100 million in crypto. Would it be possible? Let's talk to.
Well, surely, if you can have enforcement action against the community, which we've seen with OKDAO, then that's your answer.
Well, I want to hear from Ben though. So, I'm a client. I come to you and I say, I'm a multi-sig key holder of Palley DAO, which is decentralized social
token.
travel.
Tokens dropping at
What's
6
that?
p.m.
Yeah. So yes, that's right. There'll be a token drop for everyone here.
In the form of wine.
Would you could you get me coverage?
It depends. Is there a legal structure around it, or is it a stateless DAO?
We kind of YOLO'd it.
Okay. So if it's a stateless DAO, probably not. So we've just insured our first DAO customer actually for D&O cover. And the way we did that is normally DAOs actually have an entity somewhere in the world, and then that'll be the foundation, and they'll actually have we'll call the stateless DAO outside of that. So the way we did it is we insured the legal entity and then added as named insureds the members of the DAO that had control of the multi-sig as named people on the policy. So that's a little insider information. Other brokers probably want to know about that, but
Palley,
that's
I see a question.
That's how we did that.
The lady with the microphone, then we'll get to you, sir. Go ahead.
Sorry to interrupt, and I know that there's another question here.
That's fine.
I'm really interested in the innovation. I'm really interested in the insurance. What about moral hazard? Have we touched on that at all? I'm interested in derivatives, and obviously the CDOs kind of meant that maybe you don't have to worry about your investment so much because you've got
I guess the question is, moral hazard is still moral hazard. It doesn't really go away just because there's crypto, right?
Well, I was going to say, which moral hazard? I mean, from an insurance company perspective, I'm worried about moral hazard that's going to cause me to have a claim. And so, this is, I think, one of the problems. You talked about underwriting earlier, right? Is that, Coincover is actually very well positioned for what they do, right? Because they have a lot of data and they have control over their own systems. We get everyone under the sun, right? We say, oh, we got some Coincover and we want to get some more insurance on top maybe, or we have our own self-custody system, or we're using a Fireblocks, or we're on Coin, you name it, we've seen it. And God, is some of it bad. Much worse than you thought. But some of it's great too. And so the moral hazard is that you don't want to have the, oh crap, Bitcoin just, crap the bed, it's like $4,000. It was $30,000 yesterday. Man, would be really convenient if something happened to that Bitcoin yesterday and not today, right? That's the concern that you have. And so from an underwriting perspective, we can't just look at what's on chain. We can't just look at the technical aspects. In fact, I think people over-focus on custody. I think Ben and I were talking about this yesterday. I talked about a couple of people, right? There's still people involved, there's still processes, there's still procedures. And so what we require as part of our underwriting is that you attest to certain things, and depending on the size and the complexity of the policy, you demonstrate, through documentation, certain processes and procedures that you have that would actually prevent that. So I will never write a policy if I can't adjust a claim. So if you tell me I have no records and no controls over how my keys are used, you're not going to get a policy, or you'll get a very meaningless one because we're going to exclude any loss that arises where we can't demonstrate that. And so you have to go, if you do have a claim, and demonstrate to us what your policies were, how those policies were followed, okay, and that a loss resulted regardless. And we don't necessarily need to know why the loss happened, but we need to make sure that what you said you were doing was what happened. We're obviously going to try and reconstruct it as best we can. And having been involved in the first Lloyd's claim and the first insurance claim, we looked at someone, they had a claim, what they said they were doing, I think we found over 100 points of discrepancy when we actually looked at their kind of forensic analysis. And so that's how you control for moral hazard. It's maybe not satisfying to be in this real cutting edge technology that it's kind of old school, do you have processes, are they documented? Do you have logging of activity, who logged in, who initiated this, that sort of stuff. But it's part of building a holistic risk picture.
So, what you're basically saying is the way you deal with moral hazard is old-fashioned underwriting.
That's what's really cool about this, is that there is a lot of very, very crypto-specific risks that you have to deal with.
Yep.
It's cool, it's cutting edge. Like I said, I'm an engineer, this stuff kind of tickles me. But there's a lot of very traditional cybersecurity, very traditional physical security, very traditional accounting risks and best practices. And you can use that to build a very novel and comprehensive underwriting that even when you don't have the actuarial data, which stymies a lot of people, right? Because pretty much every new insurance product, you just pull up an ISO data set and you're done. Without that actuarial data, you can still build a fairly robust underwriting framework which allows you to go out and write risks and write them profitably, meaning that you're not blowing your loss pick.
So let's hear from Ian, and then we'll go to the gentleman in the blue coat. Go ahead, Ian.
Yeah, to the lady's point, credit risk. We have a CDS market. I know that market. I used to be on a trading floor, which evolved maybe 20, 30 years ago as a new financial product. In DeFi, does credit risk exist? That's a question to the panel. Oh. In peer-to-peer transactions where I'm not interacting with any central entity, is the credit risk moved on to tech risk or cyber risk? And how could a credit risk market even evolve within a more decentralized space? Obviously, credit risk between centralized entities could be priced at some point.
Well, I don't know that we'll be able to answer that today, but I would stipulate that risk can't be destroyed, it can only be moved. Mm-hmm. So if you're getting rid of the insurable risk, if you're getting rid of counterparty risk, you're creating technology risk. Mm-hmm. That's a much longer conversation. I think part of the reason the laws in the United States and our insurance policies don't work for crypto is because we're still thinking about counterparties and we're thinking about disclosure. We're not thinking about technology risk. Sir.
Great panel, thank you. I was going to ask about policy responding. You seem to have answered that very well, clarity around that. So thank you. I'm just really wondering about, I know quite a few wealth management lawyers are really reluctant to grant title or have issues around granting title. Does insurance help in that? Have you seen that in succession? When you're dealing with succession planning and granting title around crypto, does having an insurance policy really influence that? If you've even seen it yet, it's still very new, but I have quite a few clients with that problem.
Katharine, it looks like you want to answer that.
Yeah, so that's a problem that we're quite focused to solve. So obviously our key product right now is managing key material rights. So I'm in a relationship with a CTO. He's a blockchain CTO and he owns loads of crypto. And I'm hoping he hasn't died on his way back from work because I have no idea where his crypto is, right? He hasn't written it down. He's got a will. I'm like, babe, have you told the lawyer? No. And this is like two professional people, right? So if you see him, please don't run him over, right? So we are working on whether we can have something which is recognized. So generally, so we're not a custodian, right? We don't look after your crypto. We just help you not get locked out of it. So there is a massive market need for that. And I know a couple of providers are attempting to solve that, and we're attempting to support them. But there is a huge, huge need from that. And look, they estimate right now that something like 10% of the world's crypto is on a ledger device. That's a lot of ledger devices in people's underpant drawers, right? And you just really hope whoever cleans out your house doesn't just put that ledger in the bin because it's got, $1 million worth of Bitcoin on it or whatever. So definitely a lot to come, and I think I'll be interested to hear other people's opinions.
I would say you should call Ben at Superscript, and he'll call us, and we'll help your clients out.
So, they're really concerned about liability as well. They've got clients asking them what to do. They don't know what to do, and they don't want to assume the liability of this whole crypto load, wherever it's from, when they're granting title, because ultimately it rests with them. So they need advice on it. But I guess if we have an insurance policy around it, the structures are far more clear, and the liabilities are far more clear as well, and understandable.
Yeah, so, one of the things that we haven't really talked about is because we have 40 minutes.
Well, you told them to start the clock.
What's that? I did, it's true. But we have drinks in 3 minutes, so. But we haven't really talked about third-party liability insurance, and we've talked mostly about first-party property coverage, and that's the ability to underwrite and lay off that risk, I think, is going to be very significant too. Here's a question that is a little bit different, but I'd like your takes on it because I'm personally interested. As an insurance lawyer, when I saw smart contracts, or more properly, automatic scripts, I thought, nobody will be able to deny a claim, right? If you've got, so talk about, I'm curious if any of you could speak to parametric insurance, automatic insurance replacing traditional insurance policies. If you see, I know we've had some examples, the Ether risk and some other examples. Why have we not seen more of that? Go ahead.
So I think parametric insurance is really good for like on-chain events or events that can be, black and white. Really bad for liability though. So if you are getting sued or you're in litigation, it's really tough to have a really good parametric insurance solution. And even when you have a fully on-chain environment, or like what Etherisk does with the crop insurance, you still have the Oracle problem where you can manipulate the Oracle, and if somebody gets paid out for an event that actually hasn't happened, how are you going to get that money back, right? So I do think that there is. Yeah.
We'll go get it.
Yeah, I was just going to say, I do think there's definitely a really good use case for it, but it can't overturn or completely replace the system that we currently have, because the complexities of liability insurance just don't right now yet fit into that model.
So Jared, is ChatGPT going to fix that?
I'm hoping it's going to replace my lawyers. I kid. I love Palley. I think, so I really don't like DeFi insurance, because most DeFi insurance, actually pretty much all of it, doesn't like work at an actuarial level. There's like fundamental problems with it for the problems it's trying to solve. Etherisk, which incidentally is almost as old as my company, because it came on and we said, oh crap, we're done. And then we realized they were doing something very different, is actually one of the best things because they use parametric risk. I do think there's the Oracle problem, and obviously if like you see growing on-chain risk, that's going to be an increasing issue. Of course, if the Oracles have insurance from us, it would be fine. But parametric risk is really, really good, and I think that is one of the best, not only use cases for insurance on-chain, but hands down for DeFi, period, because you don't need to have that. You obviously have the technology risk of a smart contract, misfiring or what have you, but parametric risks have to be used appropriately. So one of the, like I said, there's some issues with on-chain insurance. There was a project that was trying to do on-chain insurance as a parametric risk. The problem is there wasn't enough data for it, so it will never work. But I think that is one of the best DeFi use cases, hands down, regardless of
So unfortunately, we're going to have to end it here. I was at a law firm with Dan where you would get fined $25 for each minute that you went over.